A new BMO report sheds light on how U.S. tariffs are affecting provinces. We're talking about which regions are facing the most economic pressure and why some sectors and some provinces are being hit relatively lightly. We're joined by Robert Kavcic, senior economist at BMO Capital Markets. Robert, great to see you as ever. Thanks for joining us.
Of course, thanks for having me.
What jumps out here is Ontario, Quebec, and to some extent Manitoba vulnerable to tariffs.
Yeah, and this is just consistent with just the kind of dispersion of industry exposure across Canada, right? Where if you look at what the most significant tariff burden is right now, it's sectoral tariffs on things like autos and steel and aluminum. So you just take the really simple next step and say, well, where is most of that stuff produced? It's obviously Ontario, Quebec, and in the central Canadian manufacturing base. The flip side is you look at industries where the exposure is really relatively light, like let's say oil and gas and resources. The vast majority of those tariffs, of course, stripped out by coverage we already have under CUSMA. And then you have provinces like, the Albertas and the Saskatchewans where there's not really much of an incremental impact from tariff changes at all at this point.
So it looks as though Ontario, by your numbers, lagged the Canadian growth rate last year and in 2024. Although for this year, it looks like you see Ontario not falling too far short. You see not great growth of about 1.2%.
Yeah, so we would still have Ontario and Quebec running at or very slightly above 1%. So a couple tenths below what the national average is looking like. And I think the bigger takeaway here is that we came out of a period where the provinces were really experiencing a lot of the same economic fundamentals at the same time, right? We came out of the pandemic, everyone was growing, everyone was seeing incomes rise, everyone was seeing job markets tighten up. And now for the first time, we're really starting to see those conditions break apart a little bit. And so, you can conceivably have a province like Alberta growing at, 2.5%, comfortably above potential. And at the same time, you have central Canada really struggling to grow more than 1%. And we haven't seen this kind of disparity in quite some time across the Canadian landscape.
Remember, I was in Prince Edward Island years ago, and we were driving to get oysters or something, and I remember thinking, this is great. There's no traffic. It's not like Cape Cod where everything is crowded, and why not just go here all the time? So you think Atlantic Canada, for one thing, could get a boost from stay in Canada tourism?
Well, there's that aspect, sure. And anecdotally, like last summer was a pretty strong summer from a tourism perspective, just as a lot of Canadians were staying at home. There's also, a lot more going on to kind of shape this regional dispersion than just tariffs themselves, right? So the housing correction is another factor, which is hitting disproportionately hard in Southern Ontario and parts of British Columbia. To your point, there are markets like Calgary and especially Atlantic Canada where we're not really feeling much of that at all yet. And in the case of Atlantic Canada, like you mentioned, no traffic, I think that has changed quite a bit, to be honest. And yeah, and that's a market that is just really still scrambling to catch up to a period where we had, 2, 3, almost 4% population growth in a region with a really small population base. So the correction that we're seeing on the ground in something like residential construction in Southern Ontario is just not necessarily applying in a market like Atlantic Canada right now because there's still so much catch up going on.
I'm just looking at the budget deficits, the shortfalls. New Brunswick, a small economy, relatively speaking, but a big budget deficit this year, 2.7% of the province's GDP.
Yeah, and that's kind of a theme we've seen so far. We only have, I think, 3 budgets out for fiscal 26, 2027. We're going to get the rest of them over the next month or so. But we saw British Columbia come out with, 2% of GDP or more in the deficit. New Brunswick, as you mentioned, even Alberta pushing almost $10 billion on their deficit. So if there's a really early message here from the provinces, it's that we saw a pretty sizable deficit last year. It doesn't look like it's going to narrow all that much. Maybe with the exception of an Alberta and a Saskatchewan, and this kind of just reinforces that there probably is even more disparity kind of shaping even at the fiscal level when, we're talking obviously about an oil price shock this morning a lot with WTI pushing $90. Well, a couple of weeks ago, Alberta put $60 for WTI in that budget.
Yeah.
So, right. So within a matter of weeks, we've almost swung the outlook there from a $10 billion deficit to what could very reasonably be a $5 or $10 billion surplus. And that's how quickly the fiscal situation in a province like Alberta can swing around.
And Alberta is still seeing quite a few Canadians moving from other provinces.
Yeah, and so that would be the other really big macro factor that's kind of reshaping the regional growth landscape. It's that the population caps that the federal government has put in place are not necessarily landing uniformly across Canada, right? So if you think about caps on non-permanent resident flows, somebody like a British Columbia or an Ontario, where the share of non-permanent residents is well above the federal target, right? 7-8% of the population in those provinces, they're going to disproportionately see a much more significant slowdown in population growth. And on the flip side of that is, Alberta is a market where non-permanent resident levels are pretty close to federal targets. But as you mentioned, there's also movement within Canada. And that's a province that continues to attract population flows from literally every other province in Canada when you drill down into the numbers. It's partly the fact that, look, if the economy and the job market in central Canada is struggling under the weight of tariffs, well, the Alberta economy is still growing at a pretty solid clip, and the relatively healthy resource sector is still hiring. And there's a big affordability trade still that's going on as well, where you have households kind of moving out of the Vancouvers and Torontos into more affordable markets.
And just finally, you touched on this, the impact of tariffs, but Quebec is really going to suffer this year, you guys reckon. Growth of less than 1%?
Yes, and it's part of it is the fact that just the potential run rate for growth in Quebec is relatively low compared to the national average. So the speed limit of that economy, so to speak, is a little bit slower than 100 kilometers an hour anyway. So you're going to gravitate towards lower growth in Quebec. But you're right, when you look at just like the weighted trade flows across Canada and where tariffs have technically hit hardest, it's those really elevated tariffs on steel and aluminum that disproportionately hit Quebec. So the impact on just activity directly, and probably more importantly, just business confidence as we go through 2026. Quite a bit of political uncertainty, to be honest, in 2026 as well, where firms might just be kind of sitting on their hands a little bit until we get more clarity on some of these issues.
Thanks very much, Robert. Always great talking to you. Robert Kavcic, Senior Economist at BMO Capital Markets.